Welcome to the complete guide on bonds. By the end of this lecture, you will fully understand what a bond is, who issues them, how the market works, and, surprisingly, why almost every person watching this video already owns bonds without knowing it. Let's start with the absolute basics. A bond is a formal promise to repay. When one party borrows money and another party lends it, they typically sign a written document that specifies the terms of the loan, the amount borrowed, the interest payments, the maturity date, and the collateral, if any. That document is the bond. In Hebrew, it's called ijrat hov, literally letter of debt, and the formal English equivalent is a debenture or promissory note. Now here's a key point that confuses students. When someone issues a bond, they receive money. The issuer is the borrower. The person who holds the bond is the lender. So if you buy a government bond, you are lending money to the government. The government, the issuer, got cash from you. In return, they gave you a piece of paper that says, "I promise to pay you back at a future date, with interest along the way." That's it. Now let's see who issues bonds. Two main categories. First, governments. Every modern government, the US, Israel, Germany, Japan, issues bonds to finance budget deficits. When a government spends more than it collects in taxes, it has to borrow the difference. It borrows by issuing bonds to the public. These are called sovereign bonds, or government bonds. In Hebrew, igik memshalti. Second, businesses. Companies issue bonds to fund expansion, to build new factories, finance research, acquire other companies, or refinance older debt. These are corporate bonds, or in Hebrew, igak konzerni, from the German word Konzern, meaning a company or corporation. So when you read about bonds, two main types, government and corporate. Now here's an insight that changes how you see the financial world. Every loan you have ever taken, or might take, is essentially a bond. Your mortgage? A bond. You signed a document promising to repay the bank over 30 years with interest. Your car loan? A bond. Your credit card balance? A revolving bond. Even your bank savings account is a bond, but inverted. When you deposit money at the bank, you are lending money to the bank. The bank gives you a promise to repay with interest. That's a bond. The bank then takes your money and lends it to the government by buying government bonds, earning a higher rate. The spread is the bank's profit. So you, the depositor, indirectly own government bonds without ever buying one. Same with pension funds. If you have any kind of pension or retirement plan, that plan invests heavily in government and corporate bonds. The pension fund pays you a return, which comes from the interest the bonds pay. So every working person with a pension is, indirectly, a bondholder. Now here's what makes bonds special compared to a personal loan. Bonds are tradable. In Hebrew, sachirim. Imagine you lend 1,000 shekels to a friend. He gives you a personal IOU. Can you sell that IOU to someone else? Practically no. Personal IOUs are not tradable. They have value only to you, and recovering the money is messy. Now compare that to a government bond. You can take it to the stock exchange, the secondary market for bonds, and sell it to another investor in seconds. You can convert it back into cash at any moment, at the current market price. That tradability is the defining feature of a bond. So a bond is a debt promise that's also tradable on an exchange. This tradability creates a whole new dimension of bond economics, market price. When you bought the bond from the government at face value of 100,000 shekels, you may later sell it for 95,000 or 105,000, depending on what's happening in the market. Why does the market price change? Because interest rates move. When market rates go up, the value of existing bonds goes down. Why? Because a new bond would offer a higher coupon, so old bonds with lower coupons are less attractive, hence cheaper. The inverse is also true. When rates fall, existing bonds become more valuable. This inverse relationship between bond prices and interest rates is the foundation of all fixed income trading. Now let me clarify some critical bond terminology. Face value, or par value, or principal. This is the amount the issuer promises to repay at maturity. The example we use, 100,000 shekels face value. Coupon, the periodic interest payment, expressed as a percentage of face value. A 5% coupon on a 100,000 shekel bond pays 5,000 shekels per year. Maturity, the date when the issuer repays the principal. Could be 1 month for very short-term bonds, or 50 years for long-term bonds. Yield to maturity. The total annualized return if you hold the bond to maturity, accounting for both coupons and any difference between purchase price and face value. This is the most quoted bond metric. Now I want to drive home one more time how widespread bond ownership is. Almost everyone in modern society participates in the bond market through some intermediary. Direct ownership, buying a government bond on the exchange. Bank deposits. Banks hold trillions in bonds against your deposits. Pension funds. Every pension plan holds bonds. Insurance companies. They hold massive bond portfolios to back future claim payments. Mutual funds. Many are bond-focused. So when policymakers talk about protecting the financial system, they're really talking about protecting the bond market, which underlies almost everything. Let me wrap up with the key takeaways. A bond is a formal promise to repay, a tradable IOU. Two main issuers, governments and corporations. Bonds finance government deficits and corporate expansion. The tradability is what makes bonds different from personal loans. Bond prices move inversely to interest rates. And almost every working person owns bonds indirectly through pensions and bank deposits, even if they never directly bought one. In the next lectures, we'll dive into bond pricing math, how to value a bond given its coupons and maturity, how to calculate yield to maturity, and the duration and convexity measures that drive sophisticated bond portfolio management. Thanks for watching. Subscribe, and I'll see you next time.